Wall Street makes trillion-dollar decisions every single day using a hidden equation. This equation is not just a simple formula, it controls the entire financial system. As Rafi's Finance, I am going to share this secret with you today. In 1973, two scientists gave the world a discovery never seen before. Fisher Black and Myron Scholes invented a formula that changed absolutely everything. From that day forward, Wall Street was never the same again. Right now, as you watch this video, thousands of traders are using that equation. They buy and sell millions of dollars within seconds without any hesitation at all. Without this equation, modern financial markets would be completely unable to function. The Black-Scholes equation allows you to calculate the value of an option precisely. An option gives you the right to buy an asset at a set price in the future. The price of these rights was once a complete and total mystery to everyone. Imagine that you could calculate tomorrow's price starting from today itself. Black-Scholes does exactly this and makes it possible through the power of mathematics. It is so powerful that it was awarded the Nobel Prize in economics. At the core of the equation stand 5 variables, each carrying critical importance. These are the current price strike, price time, interest rate, and volatility. When these 5 elements combine, they unlock the door to the future for you. The most fascinating variable is the one called volatility, and few people understand it. Volatility measures precisely how much the price of an asset tends to fluctuate. The greater the fluctuation, the higher the value of the option becomes. At Rafi's Finance, we do not just talk theory, we teach you real-life applications. This equation is actually based on the heat diffusion principle borrowed directly from physics. Financiers took the language of physics and applied it to markets in an incredible way. In 1997, Scholes and Merton received the Nobel Prize thanks to this very formula. Unfortunately, Fisher Black had passed away 2 years before the award was announced. But his idea did not fade. Instead, it grew even stronger with the passage of time. There is a fact that will surprise you, and very few people actually know this. The scientist who created this equation later suffered major losses using the same model. The Long-Term Capital Management Fund nearly ceased operations entirely in the year 1998. This means that even the smartest people in the world can make serious mistakes. Black-Scholes is a powerful tool, but every tool has its own clear limitations. The weak point of the model is that it assumes markets always behave in a normal way. In reality, markets frequently move in irrational ways with sharp and sudden jumps. On Black Monday in 1987, the model was completely unable to give any warning. The Dow Jones fell 22% in a single day, breaking every historical record. Despite this, the equation still governs the movement of billions of dollars every day. The annual volume of the options market exceeds 10 trillion, which is an astonishing figure. Without this equation, the existence of this market would never have been possible. Now imagine that you believe the price of a certain stock is going to rise, but instead of buying it directly, you purchase an option for much less money. If the price rises, you earn a massive return with very limited risk. Black-Scholes determines the exact fair price of that option specifically for you. If you have paid too high a price, the deal is simply not in your favor. If you paid too low, the other side wins the trade absolutely every time. This equation works to protect fairness in the market and creates real transparency. When both sides use the same model, the price forms in a much more accurate way. This is the mathematical expression of financial democracy and is quite remarkable. The most mysterious part inside the equation is the n function, rarely explained. This function expresses the normal distribution of probability in a statistical sense. In simple terms, it shows how likely any given outcome actually is. As Rafi's Finance, I explain complex concepts like these in plain and simple language, because financial knowledge belongs to everyone, not only to those on Wall Street. We are democratizing knowledge, and that is the true mission of this channel. Now, I want to share with you a truth that is very rarely discussed openly. The Black-Scholes equation does not predict the market, it actually shapes the market. Meaning the more people use this model, the more the model proves itself correct. This self-referencing system creates a unique and fascinating phenomenon in finance. When everyone uses the same model, prices move exactly where that model suggests. This is a chicken and egg problem, and it is very hard to know which came first. Hedge funds, aware of the strengths of this equation, have developed their own variations. More complex versions, such as the stochastic volatility model, have since emerged. But at the root of all of them, Black-Scholes remains the foundational principle always. If you open a bank account today, this equation is embedded in their pricing system. From insurance companies all the way to pension funds, everyone relies on it. It is so widely spread it is invisible, yet it is everywhere around you. An interesting detail is that the origins of this equation go back 200 years. French mathematician Louis Bachelier explored the mathematics of markets back in 1900. His dissertation sat forgotten and collecting dust in libraries for decades afterward. Black discovered this forgotten dissertation and brought it back to life again. A new formula was built upon those old discoveries, and it stood the test of time. This teaches us that knowledge never truly disappears, it just hides in unexpected places. There is yet another hidden side to this equation deep within the market itself. A strategy called delta hedging is derived directly from this very equation. This strategy allows investors to reduce their risk to nearly zero in practice. Delta shows how much the option price changes when the underlying asset price changes. If you know this number, you can insure yourself against every market direction. Large banks use exactly this method to minimize their losses on a daily basis. The 2008 financial crisis was a serious test of this model across the entire world. Options in the mortgage market had been mispriced due to the weaknesses of the model. Trillions of dollars were lost because the model did not fully reflect reality at all. This is why many economists say this equation must be handled with great responsibility. In the right hands, it is a powerful tool, but misused, it becomes completely destructive. As Rafi's Finance, we want to explain this dual nature in a completely open way. Today, artificial intelligence is being used to make this equation even more powerful. Machine learning complements the model to provide more accurate volatility forecasts. In the future, markets will be priced with greater precision without any human intervention. So how can an ordinary investor benefit from this knowledge in a practical way? Understanding the options market helps you make much smarter investment decisions overall. Tracking volatility gives you valuable signals about what the market is actually expecting. The VIX index is based on exactly this principle, and it reflects overall market sentiment. When this index rises, investors become anxious and a major move is expected soon. When it is low, there is calm, but that calm can sometimes be very deceiving. At Rafi's Finance, practical knowledge like this is shared with you every single time. Connecting theory to real life is our style, and it has always been this way because knowledge only gains real value when it is actually put into practice by you. Now let me ask you a question, think carefully and answer it for yourself. If the price of an option rises, does that always mean the asset price will go up? Absolutely not, because when volatility increases, the option price also rises significantly. Knowing this subtle detail keeps you one step ahead of other investors in the market. Black-Scholes is not just an equation, it is an entirely different way of thinking. This way of thinking gives you the ability to see the market in a completely new light. As Rafi's Finance, there is one thing I always want to remind you of. The most powerful asset is always knowledge, not money, and not connections either. Anyone who understands this equation has already learned to speak the language of Wall